You know, what we're going to look at today is all the options available to you when you've finished your years and years of study or years and years of work, blood, sweat and tears, and comes to retirement time, you're 60, 50, 70, whatever your age may be. And what I'm talking to today is I'm talking to those professionals. And you know who you are. The doctors, the lawyers, the accountants, the engineers, the architects, the CEOs, all those guys, financial directors. I'm talking to you. And these are people who spent 5 to 10 years studying. So you spent all those years at university studying to set yourself up for a career. You spent 30, 40 years on a career. And in that time, you know, we all know our careers go. I started off as an engineer and I ended up in property. But I digress. But what happens in our lives is we go along and we along the way we invest in certain things that are more successful than others, and we get to retirement age, we start thinking, I've got a chunk of money, I've got 2, 3, 4, 5 million rand in cash out of a retirement annuity, a pension fund, an investment. You've sold your business, one of those things, you've got a chunk of money and now you're starting to think about retirement. And what happens is you go online like most people do, you Google it, and before you know it, you've got an investment broker, a financial advisor type person sitting in front of you, and I've been this route, and I tell you what happens is I just get bamboozled. I personally get bamboozled by the information, and the people I see, these people who come and see me, they come and see me. Literally, I think bamboozled is the only word to explain it. So what I want to do, and this video is a warning. If you can read that, this is a warning to all of you. Before you spend your life savings of blood, sweat and tears, do your homework. You did the study at the beginning, do the study at the end. And this is a short video. It's quite it gets quite complex because I go into the numbers. I'd like you to please stay with me right till the end. The numbers are right at the end. Stay with me till the end. I think this 10-20 minute video is going to be well worth your while. Hang in there with me, and I'll try my best to show you the various comparisons in as short a time as possible. But before I get on, I've got a shocking story to tell you, and I think some of you will relate to this. A few weeks ago, a friend of mine walked into my office, and I happened to manage his portfolio of properties. And he's got a whole lot of buy-to-let townhouses, very well situated, all paid off, all paying him monthly income. And he came to me and he said, Neil, my investment advisor has advised me, in fact he used the word strongly advised me, to sell my properties, all my properties, one at a time, because there's a little tax incentive, capital gains tax incentive if you sell them one at a time. So it sounded very good. He said you get a tax incentive if you sell your properties one a year. So sell your properties one a year and then buy a retirement annuity with a lump sum, and then convert that into a living annuity, and do that every year with each of your properties till they're all done. And so my friend told me this is what he's going to do, and he said, what did I think? And I must say I nearly fell off my chair. And I thought, hang on a second, before we go any further, let's do the comparison, let's do the numbers. And then I realized that a while back I did a video, another Facebook video, live video, where I compared retirement annuities to a buy-to-let property. And I said it then and I'm saying it now, I'm not a financial guru, I'm a property coach. I don't have a license to sell any of those products. I only sell, I don't sell anything else. I advise people on property. At Organic Growth, we have a whole coaching facility. In fact, you can find us online at organicgrowth.co.za/coach. Hook up with me there, and we offer coaching services to enable you to build your portfolio by buying the right property in the right place and at the right price. So let's get on with our story. I've sort of pre-populated this because there's a lot of information here. The options are open to you if you're sitting with a chunk of cash is to buy living annuities. That's the advice my friend got. Or to buy unit trusts. Or to buy a buy-to-let property or keep his property. So, and again, bear with me when I talk to you through these numbers. On the living annuities, there are 3 different types that I'm going to look at. There are myriad. Every institution's got their own product. They're all slightly different, but there are a lot of similarities. And I'll take you through the main and the plain. This is very much going to be a vanilla exercise. And I've looked at a 25-year scenario. So my friend is 65 years old, and he's planning to live to 90. And he's got to plan his retirement income from now until 90, which is 25 years. Nice convenient number. So let me start with these numbers. The 733 number that you see repeated here, and the 800k number. So we do a case study here. We are comparing an existing townhouse worth 800,000 Rand, which is providing him with an income at the moment of 4,000. Let me get my colors right here. He's getting 4,400 a month at the moment, and if I take about 10% off as for vacancies and for maintenance, it's quite a generous allowance. It takes us down to about 4,000 Rand. So he's getting 4,000 Rand a month clear of all commissions, all fees, everything. So that's what we're comparing it with. So to be able to get your cash out of here to buy a living annuity or buy a unit trust, first thing you've got to do is you've got to sell your property. So I made the assumption of selling the property. Once I've taken off the sales commission for the agent and the capital gains tax, you get to this number of 733,900. Now I'm not going to go into how that calculation works, but the thing to remember is this 733,000 is tax free. It's money in your pocket after tax. There's no more tax to be paid on it. It's your money to invest. So I've compared keeping the property with investing it in living annuities or in unit trusts. So let's start. I'm going to color code this just to make it as simple as possible. So the first thing here, the first type of living annuity is level income for a maximum of 15 years. In other words, not so optimistic about his lifespan, he's going to live to 80. And that one gives you an income of, here it is, 4,400 a month. I don't know if you can see this, 4,400 Rand a month. Flatline income until he turns 80 and then drops off. So he's going to get 4,400 Rand a month every single month until he turns 80, and then when he's 80 years and 1 month, he's going to earn 0. So he's got to hope, so when he's, the month after he turns 80, he's either going to be dead or poor. That's just a fact of life. That's the first one. And people often, in fact, I know somebody who's done this. They took out one of those policies, they maxed it out, took the maximum they could, and in so doing, what they're doing is they're eating into their capital. So there's interest plus capital. And he's found that he is now, this guy is about 72, 73-ish. His income is going to stop when he's 75 and he's still very healthy. And his bond on his property that he lives in is going to last until he's about 83. So he's got serious problems. Okay, but that's another whole story. So that's the first one, where he gets a maximum income out, and this is, bearing in mind, you're going to feel poorer and poorer and poorer as the years go because of inflation. So you're actually going to get, when he turns 80, his last payment is going to be 4,400 Rand. So now we're going to the second one. Okay, I'm looking at the maximum income you can get that will last 25 years. And that's this one, 3,700 Rand. For 25 years, he's going to get exactly the same amount, and by the time he gets to 90, it's going to buy him a loaf of bread. Literally, when he turns 90, there's nothing left. He'll have, by the time he's got to 90, he's used up all the capital and all the interest. So that's those two. Then there's an inflation-linked policy as well, where you can get an annuity that's inflation-linked. And that one starts at 3,300, and it goes up at the inflation rate. They call it inflation-linked. And at the moment, inflation is 4% in South Africa. So I've taken this thing, and at 4%, I'll try and keep my lines straight here. You're going to end up here, and in year 25, when he turns 90, his income is 10,000 Rand a month. But that 10,000 Rand is hopefully going to feel like 3,300 does today. So that's what they mean by inflation linked. Okay, so that's the living annuity. But I still need to tell you what's going to be left at the end. Let me do that. So on this first one, this first one we discussed here, at the end of 25, at the end of 15 years, you're left with 0. On the one that's 3,700 per month, you're going to be left with 0 after the end of time. This one, it's inflation linked, so you're getting income or more income every month, but you're left with 0. So that's what happens. You've got to decide how long you're going to live and extract as much income as you can until you die. And strangely enough, it's called a living annuity. I struggle with that name. It should be called maybe a dying annuity. But anyway, that's what they call it. Okay. The next thing I want to look at is you decide, hang on, I'm going to buy a unit trust. I'm going to buy one of these fancy portfolios. And when you talk to the various companies, investment companies that do these portfolios, I don't want to mention any names here, but what they do is they offer you various kinds of, they offer you high risk portfolios, low risk portfolios, mixed portfolios of equities and cash, and this is where you get bamboozled. And I've seen the quotes that come out of, they're often about so thick a proper quote, and to be honest, most of it is just graphs and fees and all kinds of things, and I really battle to extract information. But I got my information, all this information I got off the internet. You can go and find it yourself. It's all on calculators. So I don't know, guesswork here. There are various different companies offering different options, and I went for what I thought was middle of the road best. That's how I did this exercise. You can go and do your own homework. Okay, so now the one we're going to look at here is the unit trust portfolio. I'm going to use black for that one. If you buy unit trust for 733,900, again you get all these. They range from about 2% up to 12-13% is what they offer you, is what these unit trusts, their return on investment is. So what you've got to decide is how much of that I'm going to live on and how much I'm going to keep in it to keep growing. So what I did is I spoke to one or two people, and what's come out actually is the friend of mine who brought me who brought this dilemma to me, the case study. He's already got a policy with one of these funds, investment policy, and he's getting he's doing a drawdown of 6.4% at the moment. So I thought let's use that one. So assuming this is a medium to high risk portfolio with an income of about 9%, income expectancy of 9%, using 6.4% as a drawdown for cash, and 2.6 goes to your growth, so that at the end of the time your capital is growing too, so your income's going to grow as well. And I'm not a mathematician, but it looks to me like your income's going to grow at about 2.6% as well. So that option, so you start at 3,900 a month using a 6.4% drawdown. You start at 3,900 and you end up at 7,200, which is about there, 720. So you can see it's not quite keeping up with inflation. Actually, the numbers here is if you keep your drawdown below about 5%, then you're actually going to experience, you'll be in line with inflation and there'll be real growth in your portfolio. But most people, they want to take as much as possible out in the beginning. You know, you're busy stepping down from a nice income to your retirement income. Okay, so at 6.4%, your income in 25 years is going to be at the 7,200 mark, and your capital having grown by 2.6% per annum, that you get out at 1.4 million. So your capital's grown from 733 to 1.4 million in 25 years. Okay. Now is the exciting bit, which is the bit I like because I'm into property, and you can see why I'm into property. Taking this property that he's got at the moment, so nothing needs to be done, nothing needs to be bought, no decision has to be made, so he can actually spend a year or 2, 3, 4 on this decision. So he's got no pressure, the money's still coming in every month. At the moment, he is putting in his sky 4,400 Rand per month that the property management company pays him, and that's I've taken, to be fair, I've taken 10% off this number to cover vacancies and maintenance. You can't read my scribble probably, but that's I've put a vacancy factor in of 10%, So we end up with a number of 4,000. Our starting point is 4,000. And and I've used a 6% growth. Now, this number, if you look at the house price index in South Africa over the last 10, 20, 30 years, bearing in mind we've got a plan for the next 25 years here. So the best way to look at the next 25 years is look at the previous 20 years. And that tells a crazy story. At the moment, houses are growing at about 4% nationally in South Africa, which is around about just under inflation. So which means against inflation, properties are not doing so well at the moment. In fact, that's why it's a great buyer's market. But 10, 15 years ago, there were years where the house price index was sitting at 30%, 22%. The price of the house was growing at 22, 30%. So I've gone for 6%. And it's a nice number because at the moment rentals are growing at about 6% as well at the moment. And again, if I look back, there were times when rental was growing at 8, 10, 12% even, and at the moment in some areas it's even leveling off or a little bit declined. But if I'm looking at a 25-year picture here, so I'm going at 6% rental growth and 6% capital growth. So on the 6% rental growth, that takes you right up to there. R16,000 a month is what he can expect to get from his property in the year he turns 90. And bearing in mind, not only is he earning that now, he's going to carry on getting that. It's going to carry on growing. And the same with the unit trust. He's going to carry on growing. So these two are very nice. They carry on growing. Unfortunately, the ones in red, they go down to zero because there's still capital here. The capital here, taking a property of 800,000 rand and growing it at 6% per annum, gives you 3.4 million. 3.4 million rand in 25 years' time. And I don't want to go into the liquidity side here, but I do know with a property you can sell out at any time and get capital out. If you end up in you find yourself at 80 and you get a dread disease and you're told you've got 2 years to live and you really need some cash out to spend on your medical bills and so on, you can actually sell your property. Likewise with the unit trust, you can take money out of it. And the various annuity policies, you can extract money. But it depends on your entry. So, and I'm not an advisor, so I'm not going to give you all that advice. I just want to look at the main and the plain, what happens with the various options. Because I must be honest, I felt like I was wading through spider webs when I was trying to put all this information together, because there's so much information on the internet, there's so much advice out there, everybody's trying to sell their product, every agent, every developer, every financial advisor, every financial institution, they're all trying to sell their product, and as we the consumer, you really got to try and do your homework. Okay, so let's do a comparison. At the end of the day, you've got to choose. You yourself are going to be making a choice, and out of your choice, you're going to live with a choice. So I've done a table here to compare living annuities with unit trusts and with buy-to-let property, and I'm going to start drawing. But I need my notes for this. Okay, so the first thing we're going to look at is your starting capital. Now with all of them, it's 800,000 rand. Now bearing in mind these two, where as you exit the property, because this is an exercise about a man with a property, he's got to sell this property. He's got fees associated with selling the property and paying tax, and then entering into an annuity. Okay, but he started with 800,000 at the start of the exercise. His income in year one, bear in mind this one was I'm in terms of the living annuity. I'm choosing this one. I'm not going to do all four of them. I'm going to choose the one that's obviously, it's the obvious example, the obvious annuity to choose if you are going to choose an annuity. So income year one is, let's use the color codes again so it's easier to see, 3,300. And his income in year 25 is 10,000. The unit trust is starting at 3,900, and in year 25 his income is 7,200. And the property, the buy-to-let property, the income after the vacancy factor and after maintenance is 4,000 Rand a month. And in 25 years' time, it's in the region of 16,000 Rand, based on 6% growth. Okay, now let's look at what happens in the end. In the end, after 25 years, we have, let's go with another color. The end capital is sitting at 0 here. 0. The unit trust, you're sitting at 1.4 million, and the property you're sitting at 3.4 million, which gives us a capital growth here. Next one, looking at capital growth, is complete loss. You've used up all the money. The money's gone, finished, gone. This one, the difference between 1.4 and 800 is your 600,000. And the difference for the buy-to-let property between 3.4 and 800 is 2.6 million. And if you want to put it in percentage, Warren loves percentage, he's here with me now. So Warren, please shout if I've missed something out. Percentage-wise, again, now I've done a capital growth return on investment. I didn't include the income during the whole period. I'm talking just the capital in the beginning, capital at the end. This one, your return on investment here is complete loss. Your unit trust, you're sitting at the difference between your growth on there is 75%. Because 600,000 is 75% of that number, and on the buy-to-let property you're sitting at 325%. So what I just want to say something about these numbers is these numbers are the numbers that are used on the graph behind, and they are net. They are net costs. They are net of costs. So in other words, they're after all broker fees and commissions. They are after agents' fees and commissions. They're after levies and rates. They're after maintenance and after vacancies. They're not after tax. I'm talking about income tax. All income is subject to income tax once it's in the annuity. So that's common to all of them, so I've left that out. This is your income before tax on this example. So I think I've said enough. There's a lot to digest here, but what I'd like to say before we go is if you know of a professional or somebody out there who's sitting with a chunk of cash and they're thinking, what am I going to do? Because frankly, if I was sitting with a couple of million rand that I knew I had to invest, I would really be quite stressed out right now. And the more I invest, the more homework I did, the more stressed I got. I really got quite I don't want to say confused, but it's very confusing going through all the numbers, trying to compare apples for apples all the time. So I've tried to simplify this as much as possible and give you a table so that you can choose. So if you want to know how to build your property portfolio, say you want to buy a property portfolio, you look through the numbers and say the choice is obvious. I invite you to read a couple of articles I've written. There's links above. Some articles I've written about retirement. I've gone into a little bit more detail, discussed the various options, and how property can help you to retire. And likewise, if you want to go and build a portfolio, please find us on organicgrowth.co.za/coach. We can help you to buy the right properties in the right place and pay the right price for them. So I think I've said it all. What I'd also like to invite you to do is ask me questions, please. Is it below, up, depending on your browser? Please ask questions, and I'll answer all of them. I'll make it my business to answer all of them. And if some of your questions are quite involved, I'll actually consider doing a whole video to answer your question. but I won't leave a single question unanswered, and I'm really pursuing the truth here. I want to make sure that that you make the right decision before you make it. I don't want you sitting here like some people I know when they were sitting at 80 and their money is finished, and they said, if only somebody had told me way back then. So hopefully this video has been of help. If it has, please share it with your friends and anybody you know who might be facing retirement quite soon. Thanks very much.